Welcome to World Business, coming to you from the 22nd floor here at Sofas Tower. Well, it's been a busy week in business, from Tim Cook announcing he's leaving Apple to the continued wrestling of some semblance of market stability from the roller coaster caused by conflict in the Middle East. Well, let's go straight to New York now and get into all of this with friend of the show, Dan Ives, Global Head of Technology Research at Wedbush Securities. Dan, always great to have you on the show. Thanks for joining us. Let's start with Apple. I mean, were you surprised? Do you think Tim Cook was pushed out? And also, what do we know about new CEO John Ternus? Is he going to be different under his leadership compared to the Cook era, do you think?
Yeah, the timing was a surprise. In Ternus being CEO eventually, I mean, he was sort of viewed as a groom candidate, given ran hardware within Apple, understands the ecosystem as well as anyone. But the timing's a surprise. I mean, it was viewed that Cook was going to stay on at least another year and a half. Fact that he's leaving now, double-edged sword. I mean, to some extent, maybe in good hands in terms of his view relative to AI. But also, you don't replace someone like Cook, and that's part of the problem.
Okay, here's a question, Dan. How long will Apple's strategy be centered around the iPhone, do you think? It's still the biggest revenue stream, isn't it? It's still growing more than the next biggest vertical, which is services.
Look, 1.5 billion iPhones in the world, 2.5 billion iOS devices. So Apple, like, that's going to be the hearts and lungs of its ecosystem. But it's also why, Ternus is a hardware guy. So, them putting him as CEO, the board, I mean, that's really doubling down on hardware. But it comes down to AI will be what would define their success in terms of the AI-enabled device, software, how they're going to monetize. They're essentially a toll collector on the consumer highway. That will be Ternus's legacy, but it's a shorter leash than with Cook, just given the global presence that he built.
Do you think there was some sense, Dan, around the table that Cook just wasn't going fast enough, far enough with AI?
Yeah, I think, look, the writing was on the wall in terms of, Cook's not going to change. So in terms of AI, that's been a frustrating strategy for Apple on the outside looking in relative to every other tech company. When you think about this AI revolution, Ternus was definitely, the candidate that everyone viewed as checked every box, but timing's key. And, it was definitely a head scratcher timing, but now the focus is what Ternus does with this.
Okay, let's look at markets more widely then. The US 100 tech index hit 25,000 points at the start of April. It's gone well past 26,000 since then. Nvidia, they've had a 15% surge so far this month. Are markets really as unaffected by the Middle East crisis as they seem? Or is there more to worry about lurking beneath these reassuring headline indicators?
On one hand, you have a fourth industrial revolution. I mean, it's the biggest tech spending environment we've seen in our lifetime, and you're really able to go back over the last 100 years. I think investors, they have really grown to understand geopolitical, Fed, from COVID to Liberation Day to even the Iran situation, you buy in the dip. Because the problem is that these create the opportunities, and as long as they stay contained and it doesn't go to some black swan event, it creates the opportunity to own tech. And that's why you've seen the dip buyers come in so strong.
Finally, Dan, Q1 earnings season's not far away now. AMD set to report on May the 5th, Salesforce towards the end of May. What have you got your eye on, and what should viewers be looking out for?
Yeah, I think the biggest focus is software, which has really been, the black cloud over the software companies, just given Anthropic fears. What do we see from hyperscalers, Microsoft, Amazon, Google? I think those are really important, as well as ServiceNow. And then it's really starting to show monetization of AI. Besides just hardware, when you start seeing it in software, and that's why it's so important, Salesforce, Palantir, in core software companies, that starts to happen. I mean, we now then start to go on a trajectory within a year, NASDAQ 30,000. I think that's not something that, is unattainable within the next 9 months.
Now, liquefied natural gas has long been a critical part of the world's energy market. Demand has been rising in Europe and quite frankly, skyrocketing in Asia. But as is obvious to all of us, it's a market that has not escaped the conflict in the Middle East. So what is the medium-term prognosis then for this super important sector? Well, joining me to help us understand all things LNG is the Chairman and CEO of Gas Strategies, Mr. Pat Breen. Pat, welcome. Let's get straight into the mechanics of this then. What are you actually seeing in LNG flows right now? Cargoes being delayed, rerouted, cancelled, and in what volumes?
Well, I think the bottom line on this is that the last 50 odd days we've had Strait of Hormuz, the access route for supply of LNG from the UAE and from Qatar, effectively shut off from the rest of the world. And in overall terms, you know, we turn around and we see that that's 20% of LNG supply that is no longer reaching its markets. So I think, you know, we see lots of uncertainty. We see lots of phantom announcements about the potential reopening, lots of uncertainty. Will it, won't it? But the reality is that we're now in a position where around the world, and you know, we have to recognize that Qatar and the UAE are global suppliers of LNG. The last deliveries have been made. So 53, 54 days into the crisis, I think we're really coming to the end of the beginning of this without sign really of the end.
Okay, let's focus on pricing now. How much of the current move is risk premium versus genuine supply disruption? If you had to put a split on it, where does it land?
I think it's an interesting question. I was discussing this with some of our team this morning, and I think the distinction between risk premium and supply constraint driven price difference is really a differentiation between oil and LNG. I think if we take oil, I think we have really a much more of a risk-based loading on price. We see more volatility. And of course, we need to recognize that oil is a far more financially traded product. And so therefore, you see more volatility in price, as we've seen in the movement this morning with the announcement of the extension to an unknown end of the ceasefire. On the other hand, with LNG, LNG is quite different in its characteristics to oil. We have a much tighter market. We have much more constraint on storage. We don't have the same strategic storage that we have around the world for oil. And also the extent to which you can have substitution for LNG is much less compared to oil, where different grades of the product can be substituted for others. So I would turn around and say that this is very much supply disruption driven on the price front for LNG.
Okay, let's talk contracts now. Are long-term LNG agreements holding firm here, do you think? Or are we starting to see stress in delivery obligations and flexibility clauses?
Fundamentally, the shortage that we're seeing coming out from the events in the Strait of Hormuz is the non-fulfillment of long-term contracts, which have been entered into, particularly to Asian demand bases. So, you know, that is a key characteristic of what we see happening in terms of the supply constraint at the moment. If we look back on the supply-demand disruptions that we saw in the days of COVID, and we did have, you know, a very much a bounce back at one stage where we were supply constrained, and on the other hand, before that, we actually had demand fall off. In each case, we saw disruption in terms of behavior around long-term contracts. And the one that's most relevant to this, I would say, is where we saw an imbalance with more market demand than we saw supply. In that case, we saw some behaviors of parties relative to their contracts, short and medium-term contracts, where they did not particularly honor in some cases the supply commitments that there were because of the economic advantage that they had in diverting those supply to other demand points where they could achieve higher spot prices. And in those contracts, we actually saw that the financial remedies for non-supply were relatively small compared to the economic advantage from the diversion to spot opportunities. That led to a lot of disputes after the return to normal business after COVID. And I think that we can suspect that some of that behavior will be taking place. How much of it is actually visible at the moment is harder really to comment on at this stage.
Well, you've worked across these markets for years. Where is the system tightest right now? Is it shipping capacity, liquefaction, regasification, or something else?
Well, this is a supply-driven phenomenon. So on the demand side, on regasification, we don't have a constraint. Okay, that is one of the characteristics, of course, on regasification that we saw with the Ukraine crisis, where there was demand in Europe for gas, but there just wasn't enough of import capacity to get the LNG supply through and regasified. At present, our constraint, of course, is liquefaction capacity in terms of the ability of that capacity to access the market. So the liquefaction capacity is there. It's the constraint of the deliverability of the product through the Strait of Hormuz. On the shipping side, there will be some constraint with the demand of longer distances to take, for example, LNG from the Atlantic Basin through to Asian markets. And we've seen some of that reflected in the movements on spot charter rates in LNG carriers over the last 30 to 40 days. What I would say to you is that I think that the last 50 days have really been a relatively easy period for a number of reasons. I think it has been beneficial that we've been coming out of the winter period, and therefore there's been more opportunity for cargoes that would have been moving to Europe for them to be diverted through spot deals to the Asian markets. So we've seen, about 11 cargoes that would have had European destinations redirected in the month of March to Asia. That's been possible because, we were reaching a more attractive period from a weather point of view coming out of winter. And also there still was some gas in storage in Europe. I think as we move forward, we're now going to quite soon get into a space where Asian markets are going to be seeking to fill their LNG storage in anticipation of the next winter. And we're also going to have the European players who are going to have their storage obligations to be fulfilled, where they need to, by October, November, have at present 80% of storage filled in anticipation of meeting the new regulation requirements that were introduced for Europe for security of supply after the cutting off of Russian gas. So I think we really, at the moment, while we could be spending a lot of time looking at price movements and looking at shipping movements, I think we really need to start looking at what happens if the Strait of Hormuz situation continues for 30 days, 60 days, even 90 days. And I think we need to look at that in the context of, even if the events in the Strait of Hormuz were to end tomorrow, how long will it take for the restoration of LNG supply from wellhead through to liquefaction, through to getting shipping into the right place, in order for us to regularize the behaviors of Qatari and Emirates supply reaching global markets? And I think we count that now, quite frankly, in a number of months, multiple months, and that will coincide with the challenge of the refilling of LNG storage in Asia and in Europe. So I think we face quite a complex and challenging world, even if a situation was resolved in the morning.
And on alternatives, we hear a lot about diversification, but in hard numbers, how much volume can realistically bypass Hormuz in the next, say, 30 to 60 days?
The reality is that for LNG, there is no route to bypass the Strait of Hormuz. The Qatari capacity has no other route to market for LNG, nor does UAE LNG. This is capacity which is locked in while we have these constraints on supply and the movement of shipping.
And do you feel that we're seeing governments adequately step in behind the scenes here? Strategic reserves, diplomatic pressure, shipping guarantees, or do you feel the market is still, to some degree, largely on its own?
Well, we've seen the actions that were taken and announced by President Trump around the offering of insurance cover for the movement of vessels in the Strait of Hormuz, which really did not address the safety issues that applied to crews, and so that did not make a difference. Governments don't particularly have an interest in raising great concerns about the events at present, and we do see some activity on behalf of some of the Asian players, things where they have maybe more clearly got national champions that are managing their gas and LNG supply. And I think we do see an interest and a readiness to go to the market and pay premium prices for the possibility of alternative supplies for multi-year cover in order to give some security of supply given the current situation with Hormuz. But quite honestly, I would have said up to now, there's probably more hope than action to address this issue and hope that the situation will resolve itself. I think even at this stage, this is unrealistic. And I think we're already at the point now where we need to see definitive action being taken. The particular action that's probably being taken at the moment is maybe a bit like we've seen on the jet fuel front announced here in Europe in the last 24 hours. There is more action to address demand side issues in order to address a shortage situation, rather than to look towards alternative sources of supply and addressing this from the supply side.
And from a trading perspective, what's the signal you're watching most closely right now? Is it something like freight rates, insurance premiums, or perhaps something else less visible that might indicate that stress is building?
It's an interesting question, and I think some of those indicators that you just mentioned are really reactions to the market rather than being any kind of lead indicators of themselves. I don't think in LNG we can say that we really have any kind of a lead indicator. And so I think we are reading the situation and reading the challenges on a day-to-day basis. I think, as I said earlier, the challenge is for people to start moving now towards maybe a more proactive approach to actually look at how do we manage this towards a 30, 60, 90-day continuation of this situation.
And just finally, Pat, if this uncertainty holds then, where does the real breakpoint sit? What has to happen for this to tip from disruption into a full-scale supply crisis?
I think it's recession. I think it's governments realizing that recession is inevitable. And I think that it's going to take action at that level and that recognition for an escalation on a multi-country basis to prevail in terms of seeking a resolution to this situation.
Well, Pat, we thank you very much indeed for joining us. Well, that is all for this week. Please do join us again next week for more World Business.